Tesla is a trap right now, and I am going to show you exactly why the data says do not touch the stock. Tesla just dropped another 1.8% today, sitting at $355, and the composite score on this name is a brutal negative 70 out of 100. That is not a dip. That is a warning sign. Here is why I called it a trap. Let us start with the moving averages, because they paint a very clear picture here. The 20-day EMA is sitting at $385, the 50-day EMA is up at $403, and the 200-day SMA is at $396. Think of these moving averages as layers of traffic on a highway. Price needs to punch through each one to get back to healthy territory. Right now, Tesla at $355 is trading below all three of those levels. That means the 20, 50, and 200-day are all acting as resistance above the current price. When price is below all three major averages, that tells us the trend is broken across every major timeframe, short, medium, and long term. There is no floor of moving average support underneath this stock right now. Now here is where it gets interesting, and not in a good way. RSI, which measures how overbought or oversold a stock is on a scale of 0 to 100, is sitting at 31.8. That is just barely above the oversold threshold of 30. You might think that sounds like a buying opportunity, but here is the critical piece: there is no divergence. Divergence is when price makes a new low but RSI starts climbing, signaling that selling pressure is exhausting itself. We do not have that here. MACD, which tracks the momentum behind the price move, is also deteriorating. The ADX reading of 27.4 tells us the downtrend has real strength behind it. This is not a stock running out of sellers. The momentum is still pointing down. Volume tells us who is doing the buying and selling, and right now the volume pattern is flagged as distribution. Distribution means big institutional players are selling into any strength, quietly unloading shares onto retail buyers. The money flow index at 36.9 confirms this. MFI combines price and volume to measure buying versus selling pressure, and a reading under 40 on a falling stock means the money is flowing out, not in. Smart money is not accumulating here. On the price pattern side, Tesla is printing lower highs. That is the textbook definition of a downtrend: each rally attempt fails at a lower level than the one before it. There is no double bottom forming, no bullish divergence, and no Bollinger Band squeeze setting up. In fact, price is currently below the lower Bollinger Band. Think of the Bollinger Bands like guardrails on a road. When price breaks below the lower guardrail, it means volatility is extreme and the move is abnormal. The bearish fair value gap signal adds another layer, indicating that institutions have left unfilled sell orders above current price. From a market structure perspective, Tesla has confirmed a bearish break of structure. A break of structure, or BOS, means price has taken out a key swing low, signaling that institutional sellers are in control. There are no nearby order blocks acting as a floor, which means there is no identified zone where institutions previously placed large buy orders. The liquidity picture is also concerning. With no support levels identified below current price, there is no obvious level where big buyers are likely to step in and defend. Here are the key levels to watch. On the support side, the data shows no identified support levels below 355. That is a red flag on its own. To the upside, resistance comes in at 359, then 368, and the big wall is up at 389. That 389 level lines up closely with the 20-day EMA. Until Tesla can reclaim 359 with conviction, every bounce is just a potential shorting opportunity for the bears. So here is the bottom line on Tesla. This is a trap, and here are the 5 reasons why. Number 1, price is below all 3 major moving averages. Number 2, there is zero RSI divergence to signal exhaustion of sellers. Number 3, volume is in distribution, not accumulation. Number 4, the market structure is a confirmed bearish break of structure. And number 5, there is no identified support below current price, meaning there is no technical floor to catch a falling knife. The composite score of -70 is not a misprint. This stock is in a cycle stage 1 downtrend with momentum, structure, and volume all aligned against the bulls. Here is what would need to happen for the bulls to take back control. First, Tesla needs to reclaim and hold above 359 on strong volume. Then it needs to clear 368, and ultimately get back above the 20-day EMA near 389. If RSI starts forming a higher low while price makes a lower low, that divergence would be the first real green flag. Until those conditions are met, any bounce should be treated with serious skepticism. The bear scenario is straightforward and frankly more likely given the current setup. If Tesla fails to hold 355 and breaks lower with heavy volume, there is no technical support to slow the decline. Watch the Z-score, which is already at negative 2.23, meaning price is more than 2 standard deviations below its mean. If selling accelerates, a move toward the 320 to 330 range is on the table. A close back below 350 on high volume would be a serious warning that the trap has sprung. 3 key takeaways. 1. Tesla is below all major moving averages with no support identified below it. 2. Volume is distributing and momentum is deteriorating with no divergence to suggest a reversal. 3. Do not mistake a low RSI for a buy signal. Without divergence and accumulation, oversold can always get more oversold. That is today's Dip Detective deep dive for Tesla. If you want to know when this trap finally turns into a real bottom, hit subscribe because we will be watching every signal. Not financial advice, do your own research, and we will see you in the next one.